Welcome to the Gray Report. I'm your host, Spencer Gray. And if you're a multifamily investor, active, passive, or you've been in the industry, well, this is the YouTube show and podcast that was designed just for you. We're breaking down all the latest data, research reports, articles, and throwing out some original commentary covering the multifamily industry, housing, and the economy. As is every week, it is so important to pay attention to how things are moving. This week is completely different from last week as it was a couple weeks ago. So we've got stories related to the Federal Reserve, Jerome Powell speaking in front of the Senate Finance Committee recently. New ADP employment numbers have come out. We also have reports from CBRE and Realtor.com on the U.S. housing supply and new supply coming online this year. If you haven't heard, we have more housing coming online this year than we have in years. So something really important to pay attention to. We also have a really fascinating new survey and report that Camden Wealth just put out, just sent to us. Since I participated in the survey, we got it a little bit early. This is going into what the smart, or at least the deep pocket money, how they're seeing investments going forward, specifically in private equity and real assets. So a lot of insights of where those high net worth individuals, family offices, and institutions, how they're looking at investing into alternatives going forward. You're not going to want to miss this episode. Make sure you're subscribed to the Great Capital YouTube channel so you can stay up to date on all the latest episodes. All right, let's get into it. All right, welcome back to the Gray Report. Thank you again. Matt Bosnagel, Director of Communications and Marketing here at Great Capital, joins us once again in the co-host seat. Matt, how's your week going?
It's going pretty well. It's going by so fast, it seems like.
I know. I can't believe it. I mean, it's Thursday. We usually record on Wednesday. Just time flies. Yeah. It's incredible. I'm closing out to the end of the week. And I'd say, again, every couple of weeks things change. I mean, if not daily or weekly, but
it's always something.
I had lunch today, Matt, with some lenders, and we were talking. We'd gotten together with the same folks at NMHC back in Las Vegas at the end of January, and just the conversations in the tone from end of January to now just the beginning of March. Like we're talking a month, 6 weeks maybe. And the tone has already changed. And I would say, not that everyone has changed their tone, but I would say some of the folks on maybe the investment sales side, the brokers and some other lenders, the conversation has now shifted from, well, at the end of this year, rates are going to be lower. The buyers are going to come back and it's just going to be roses. All is going to be good at the end of the year, to now saying, yeah, that's not going to be the case. And people talking much more about, how they save their deals rather than, oh no, I'm going to still be able to get a big cash out refinance here in the next, 6 months or so. We've been talking about this and warning about what people are talking about now for really the last year, man. I mean, it was March when we shifted our stance. But it's interesting now, seeing some of these other folks that are now just kind of coming to terms with reality.
I keep thinking about you talked about yesterday, multifamily is a slow boat to move, to react to some of these things. I think a lot of people are waiting until the very last chance, until there are no alternatives available. But what I keep coming back to is this idea of you could be forward thinking. When is there going to be some switch that flips and people are like, oh, I got to get ahead of this? And is there going to be a realization, or is everyone just going to collectively wait until the last possible moment?
I think people are realizing that they need to start moving now. Obviously it depends on their situation and the timing on their assets. But I think that the idea, though, that you're going to have an opportunity to sit out and wait till next year, and that idea is going away. I think people are now saying, well, yeah, maybe in 3 to 5 years, things are going to be looking great. But not as if you have to do something within the next 12 to 18 months, you might want to do it sooner rather than later. And even though that, like, locking in a fixed rate now, like, doesn't seem that exciting because, you're locking in the sixes maybe.
Mhm.
But if you're on a floating rate, or a bridge loan or something, you could be paying in the 8% range.
And that's what's so kind of interesting right now is, okay, if people thought they could float it for the next year, if they had that calculation at the end of January, and then there could be, if all it takes is one more other interpretation, suddenly you're in a worse spot. You
Yeah.
need to sell in 12 months, and then you think, well, might as well sell now. So you're going from 2 years of safety to maybe 2 months to sale, based on your interpretation. And it doesn't have to be that different of an interpretation. There's seen where a lot of people, I think, are balancing on the edge of a knife, and we'll
Yeah.
see. I think some people are going to fall into, some distressed sales.
Yeah. I think so. Now there's a lot of money floating around, a lot of rescue. Everyone's talking
Yeah,
about rescue capital, what's going to be palatable, what's not going to be palatable. But there's going to be some people in some not great situations. And what I keep coming back to is what's going to be exposed, and what's being exposed already is um, those who structured their deals and who took on significantly more risk than others.
hmm
And it seemed like there wasn't that big of a difference of, floating rate, fixed rate. And there was a period as soon as a year ago, 2 years ago, people were saying, why would you go fixed rate? You're leaving so much money on the table. There's high prepayment penalties, which is true. So you might not be able to exit as quickly as you thought. The rates were lower on the floating rate stuff. The caps weren't that expensive. It was like the savvy and smart thing to do. You could get a little higher IRR. But we're seeing how extra return is directly translating to higher degree of risk. And where it
hmm
seemed like just a little bit more risk for a decent amount of return, now it's like a decent amount of more return or none, actually.
yeah,
And you've taken on so much more risk, and now your asset is actually at risk. And where the conversations are moving from, how do I crank out a good multiple? How do I get a good cash out refinance, to how do I preserve capital? How do I preserve the asset? And those conversations should have taken place when the business plan was put together.
yeah,
We're going to go forward on this. Okay, what if some worst case scenarios? What if those come true? What if those things happen? How does this asset respond? And what can we do going into the deal that's going to set us up so we don't have our back against the wall?
yeah,
Because there are a lot of groups that their back is approaching the wall, and only because the decisions that they made in the short term that seemed like they were the savvy investment decisions, risk management was not really being done. And there are others, though, that have long-term fixed debt that are sleeping very well at night. If you've got a more than a 3-year time horizon, I think you're good. If you got 5 years, you don't have a whole lot
yeah,
to work out. 10 years, good.
yeah. And I think we talked about that, whether it was last week or the week before, is how, time is risk. And the more time you have, the less risk you are, that period is going to be characterized by any single interest rate regime. And you'd like to think that it evens out, unless it's, something crazy like
Yeah.
what was in the 80s. But I all signs are pointing to this being finite. But if you have such a limited time horizon, then a small change in the interest rate could really send things into the negative, and force a very dramatic decision. Maybe it's
Yeah.
to sell.
Because it's not just interest rates, Matt. As we've talked about, you got your interest rates that's moved up. So if you're on a floating rate loan, your debt service has doubled or tripled depending on how you finance it. But that's only what's one factor. You've also had cap rates are going up. They have to, because
Yeah.
financing rates are going up. So cap rates are going up, where people are now looking at, the 5.5, six caps are where I need to be instead of 3s and 4s. So you've got your valuation multiple has depressed the actual valuations of the assets. But on your income, which the values, that's how the assets are actually valued, is how much cash is throwing off. What's your net operating income? You've had net operating income declines. You've had rent declines. You had negative rent growth. You've had expenses going up. So it's simple math, numerator, denominator. Your value is your net operating income divided by your cap rate. Well,
Mhm.
your net operating income's gone down. your cap rate's gone up. Like, I mean, your value has gone down significantly. So how it's
Yeah.
penciling.
And I think that you mentioned this actually. You talked about apartment supply when, and this is a little bit more of a teaser, but for certain markets, the apartment supply is going to go up incredibly, and in other markets, it's not. And it's easy to find, which ones there. Let's say Phoenix, for instance, has a lot of new supply. What if you had a floating rate loan on a purchase at the wrong time in the Phoenix market where you're getting a lot of supply? That's like the odds are that doesn't eliminate every single person. There are plenty of people that probably did that and are probably facing this situation.
And there are also folks that
Not
probably
all.
bought something in 2019 who put a fixed rate loan on it that's
Mhm.
in the most low fours, and they're doing great because they've had great rent growth over
Yeah,
the last couple of years. The declines don't wipe out all the rent growth. They still have great growth, and they've got fixed debt, and they're doing great. And
yeah,
nothing to
that's a
worry about.
very good point.
It's totally about execution. Now, someone could have bought that same asset in the same year and have had a floating and have used a floating rate loan on it, and they felt really smart the first couple of years. Maybe they sold it in 2021. Maybe they refinanced it. Maybe they're holding on to it, but now their caps are being readjusted. They have to, they're getting ready to buy a new cap. If they don't already have to buy a new cap in their escrows. Now they're still going to be in a better spot, but they are paying much more in interest than they thought relative to the fixed rate borrower than they thought they would have been back in 2019.
Yeah,
It's all risk and reward. You said time, time you can reduce your risk. It also reduces the return.
yeah,
But it's how it's can't separate the two things of risk and return. And the idea of risk management right now is so important. And we talked about this, Matt, again, a year ago, saying there have been new areas of risk that have been introduced to the market, new factors that there are these areas of exponential risk. And if you're not looking at the idea that we were last year, interest rates are moving. Like we were looking at the dot plot. We're listening to everything the Fed is
hmm
saying, and this is where we're going. They communicated it very specifically.
yeah.
Um,
Well, that's actually a
unless
good lead in.
yeah, why not?
If you want to.
So now,
Yeah. Sorry.
and so like the Federal Reserve, they're committed. Like they are
hmm
committed. Part of it is just it's saving face from them being too slow to react, keeping monetary policy way too loose for too long, and now they're doing whatever they can to try to bring inflation in check. And you got to get out of the way of the Fed. And the same people who are saying don't fight the Fed back in 2021 were still the same people that were essentially going the opposite direction of the Fed all last year and putting more floating rate debt on it and bridge debt. That's going to become expiring. Some at the end of this year, a big end, but then 2024 is going to be an interesting period as well, Matt. So again, it's not just like
Yeah,
this year. We've got some times again, like end of 21, a lot of deals closed at the end of 21, incredible amount of volume, 2-year bridge loan. Where does that put us? It puts us, throughout 2024. So
yeah. That's and a lot of the projections were that 2024 is going to be the rough point. Even actually some of the government's own projections and some of their worst case scenarios at 2024 was where there was a little bit of a shakeup.
yeah,
Um, but yeah, when you're talking about communicating it, I think that there's always a benefit of seeming like more hawkish from the Fed. They don't really stand to gain that much by seeming more dovish, by telling people, "Oh, no, don't worry about interest rates." They are consistent in their message in that
well, especially
that
if you want to control inflation.
yeah,
The last thing
yeah,
I want to do is be like, hey, all is good. You don't have to worry about it. Go out and spend some more, go buy some more things.
yeah,
That's not good. So let's pivot. Let's talk about
yeah,
because Powell was up on Capitol Hill. He was answering senators' questions. It's one of the big pieces of monetary policy people were waiting for, just to get a little bit of insight. And since we've had all this new data from employment from the BLS, but we've also just gotten a new ADP report, which is not a government report, private market, but so it's a little bit different metric. But the economy's still running hot, man. We've got people who are still finding jobs. We're hiring
yeah,
way more than we're firing. And Senator Elizabeth Warren, kind of got on Jerome Powell. basically calling them out for saying that they are trying to create unemployment, and they're like, you're trying to basically have 2 million Americans lose their job. What do you say to those 2 million Americans? His response was, well, what do you say to everybody else? What do you say to the other, 290 some million or however many people who live in the United States these days who are suffering from inflation, this hidden tax? What do you say? What do you say to that?
Well,
On a daily basis.
You say things are going to be more expensive. We want these jobs. That's what I say.
Yeah, you can say that. You can say that, but
well, I'm not Jerome Powell, and my point in the whole thing about communication is, Powell's remarks there's only like billions and trillions of dollars that are listing for the smallest, subtlest signal that interest rates might increase or decrease, and hearings and appearances on a panel like Jay Powell made in front of Congress this week. They are it's not like a ritual, but it's definitely carefully measured and carefully crafted. He doesn't want to seem like he's going too strong or too soft, but there is still a little bit of things that are open to interpretation. If Powell didn't open his mouth, then maybe we wouldn't have the headlines that said, stock signals are down after he has said that, maybe it's running a little too hot.
But that's been some of the criticism recently, is that the Fed is being too transparent and trying to communicate what they're trying to do. I think, depending on, what day of the week it is, you get people saying the Fed needs to be much more transparent or less. But the reality is, anytime any of the Fed governors speaks, obviously, especially Chairman Jerome Powell, it has a major effect of moving markets. To your point, Matt, people are trying to parse every single word and read in between the lines and go through the beige book and read the minutes. But a lot of this is intentional, is they're trying to throw water on the stock market or the employment market.
But they don't.
I don't know. I don't know.
They always try to. It's almost like they want to throw water on things, or at least maintain a little bit of mystery. He's a little bit coy about things. Like, oh, I know, I'm not going to tell you. But justifiably so, because he knows. But so what he specifically said, I think, that sent everything in motion was on Tuesday. He started saying, and he kind of finished saying it the next day. On Tuesday, he said to the Senate, the latest economic data have come in stronger than expected, which suggests that the ultimate level of interest rates is likely to be higher than previously anticipated. Okay, and then on Wednesday, he said, and I stress that no decision has been made on this, if the totality were to indicate that faster tightening is warranted, we will be prepared to increase the pace of rate hikes. So he tries to, lessen or dampen his hawkish comments from Tuesday, but the point is still pretty strong. But to me, his comments on Wednesday really didn't do much. We're 6 days out from the next CPI print, but the last one did not signal rampant inflation. However, the PCE, which is the personal consumer expenditure numbers, they were released on February 24th, so a little old, but they're more worrying than the actual CPI numbers. And they have inflation, PCE inflation, going up 0.6% in January compared to just 0.3% the month before. I think that one of these things that, you can interpret things however you want, but the sign and the data that is coming in, and you may have mentioned the jobs numbers too from ADP. Those numbers are not they're not good signs, and we could be headed easily, I think, for a 0.5% rate hike.
Yeah, no, I mean, certainly they wanted to put that on the table to communicate to markets of hey, we're not done yet, and we're not going to be done. I mean, think about Matt. Who are the people who are really saying they need to bring interest rates down or stop doing it? It's like people in the stock market. It's like it's the investor class that's saying this. We want our deals to pencil, so I need you to bring interest rates down. They're looking at it and saying, yeah, but our unemployment rate is in sub 3. In many markets it's 2. It's in some Indiana markets it's under 2%. So why? And we have inflation. We have people are spending more money on eggs, on whatever. And why would I lower interest rates for who?
Yeah, because people's experience with inflation is a lot sharper and more painful than I think in general than the average person's experience with interest rates. They're not following them. They engage with them maybe when they're buying a home or a car or something like
Unless they're
that.
buying a home or a car or a car, and it's even
Mhm.
probably less on a car.
Yeah.
It's really when you're buying a home. But other than that, and then
Yeah.
and a lot of homeowners, if we were like Europe or other places in the world, and most single family homes are financed with a floating rate product, we'd be having that
Mm.
conversation. But they're
Yeah.
not. Everyone pretty much uses some sort of fixed rate financing, 30 or 15-year fix, because obviously what happened, great financial crisis. And again, like just we're talking about multifamily, everyone that did is in a good spot. No one's underwater. No one's worried because their finance for 15 or 30 years. They're kind of stuck. Who is going to go trade out their 3%
Yeah.
mortgage for a 6% right now?
Yeah. Now, another thing that I was thinking about in terms of, what's the attitude and what are the effects on the economy, but I would kind of argue that the housing market and the apartment market specifically, it hasn't completely reacted to the increasing interest rates that began last year. Now, calculations are changing, and I think another worrying thing is in some of Powell's comments, he also talked about, maybe even revising the terminal rate that they're going for up. So it's not just
Yeah.
maybe we're getting another 0.5 increase, but maybe we're going to go higher above 5% than was
Yeah,
previously
into the
anticipated.
six, seven.
So
I
that's
mean,
almost scarier. Just to kind of look forward to that
yeah, because
is
most people
not
didn't
so.
have that priced in.
Yeah.
You're absolutely right. And you made another good point, Matt, is that, we're talking about, previously we were just talking about in the last segment, talking about, okay, well, the numerator denominator, just like your valuation calculation values are down, but those are all just, paper valuations. And the value, you can take a valuation at any point in time if you want, whether that's yourself doing it or you're actually getting an official appraisal.
Hmm.
But at the end of the day, the true value, it's not until you mark to market, you actually have a transaction. And the only transactions
Yeah.
that are happening, at least today, are people who are getting the price they want. It's a 1031 exchange buyer or someone who has a lower return threshold that still is out there buying. And there are still folks out there that are buying at, 5 caps and sub 5 caps. That number is dwindling by the day, but there are still enough of those out there that the few transactions that are taking place, albeit higher cap rates than they were a year or 2 years ago, but some folks are still getting decent prices. Because people just have to place capital. Those are the only deals that are really
Yeah.
getting done, unless it's an assumption. Um, but like if the deals don't trade, you're not really setting a market if the transactions actually aren't actually occurring. I mean, we can have conversations all day long on a given
Yeah.
day. I mean, I remember when the pandemic was starting and the 10-year dropped below 1%. And in my mind, I knew that cap rates should then be coming down. And I knew that I'm like, really, on paper, the value of all of our assets just shot up or will shoot up. Well, can't have our cake and eat it too. The opposite also applies.
Yeah.
But at the same time, when the 10-year fell below 1%, it's not like I was, calling the bank and saying, we could have done this, I guess, in the form of refinance, but like till a transaction, maybe like a refinance takes place, it's not real. It's just numbers on a piece of paper,
Yeah.
on a calculator. It's not real value. So,
Yeah. And kind of tangentially related, something that I wrote in the newsletter is these things that have an effect on the buying and selling of apartment properties. They're not as like the straits are not as dire when it comes to rentals and like the fundamentals of multifamily properties specifically. Um, I think that the problem, at least has been characterized in all the reports that I've been reading, is really a problem about getting financing. It's not, we're not looking forward and getting scared about renters not showing up. I think that, and we'll see in a couple of reports in this show that the housing demand's still there.
yeah,
Um,
yeah,
but again, what it means for multifamily, I think, is that I would argue that multifamily has more cushions to wait out periods where apartment prices go down, like you mentioned. But with these signals from the Fed that interest rates could get higher, that timeline, like we kind of discussed earlier, timeline gets longer and longer, and it's going to be really interesting to see when enough deals get made that really start to characterize the market. And you said, the deals that are getting made are the ones where the sellers are finding their price and it may be
or
maybe sooner.
creative financing. I mean,
Yeah.
that's the only way to get like an actual deal
Okay.
done. Or
Yeah.
someone's like, yeah, I'll pay a stupid price because, looking at what my tax bill would be, if I can defer it, I can take a lower return and still come out ahead. There's probably some mistakes being made because of that. Also, people buying stuff they probably shouldn't, being like, I got to place the money and I want to save $1 million, that I'm going to pay taxes on. But then if it,
And I think, well, and I may be putting words on their mouth, but the implication there is that those deals do not kind of characterize the market where we're at right now, and maybe we need a little bit more price discovery where more deals hitting the market to really say, actually, the typical person looking to sell is
yeah.
this is the number.
And they're just not, I mean, there are deals that are hitting the market. People are floating stuff around there. They're seeing, if there's people are fishing for
Yeah.
buyers. But fewer and farther, and some deals are closing. Deals have, I mean, we bought a deal a couple weeks ago. There's an assumption. But they're few and far between. Matt, sorry, go ahead.
Yeah.
Go ahead.
No, and I just want to characterize this whole when I'm talking about potential opportunities and this the idea that the apartment prices might be going down, property prices, I get excited about it as a buying opportunity because I believe in the fundamentals of the apartment market and supply is coming along and that is going to change things, but it's not in every market. There still are opportunities, and it's something that otherwise it would be a real tragedy if everything was going up. But really, there are some bones and some real good fundamentals there.
As depressed as I can get of being like, oh, I can't, it's just not the time right now. It doesn't make sense and nothing pencils, because we're like using more conservative assumptions and our return thresholds have gone up. It's even harder to hit. Then like you keep like going around the bend, and it's like, hey, this could be a very interesting buying opportunity when the market gets to where we are.
Yeah,
it's just not there yet. And we're just, again, from a Great Capital's perspective, we're sticking to our kind of fundamentals, the way we view the world and the economy and the market, and we know what we believe is a fair value to get returns that justify the risk. Because we're approaching it from a risk management perspective, capital preservation perspective, and we're just not getting close right now. But we think the market is going to get to a point, and we're staying like having active conversations. We're going to be in the right position to take advantage of the opportunities when they present themselves. So I get very excited about like the potential opportunity coming down the pike, but then you just keep going, but it's not here yet. It's not here yet.
Yeah. Keep your eyes open. I think
we're digging trenches is what we're doing right now.
That's good.
we're digging trenches.
Keep moving forward.
Exactly. Yeah. All right. So I want to touch on this ADP number.
Yeah.
We're talking about macro stuff. Went back to multifamily, Matt. And this is good. Not only talking about where monetary policy is headed, but it's also like, how's the general economy doing? If people have jobs, people should be making some money, and people should be able to pay rent, which is all good. Now, good news is, good news for people who love bad news. Again, we're, same Modest Mouse album every week. We had 242 freaking jobs. That's so great it's bad, man.
Yeah.
That's not good. It's great. It's not good. It's great.
Well, it certainly puts the lie to the idea that tech layoffs are characterizing the market, which no one really, said, but you hear a lot. And Mark Zuckerberg told Facebook Meta employees that this is the year of efficiency or something, and that's how he fired people. And so there's a lot of tech companies are firing people, and it's not a lot of people are hiring. A lot more people are hiring.
Yeah,
it seems like.
So Nella Richardson, chief economist from ADP, you'll see her on the fancy finance shows. Just a quote from her: "There's a trade-off in the labor market right now. We're seeing robust hiring, which is good for the economy and workers, but pay growth remains quite elevated. People are making too much money."
Oh, that seems like two good things.
I know. There's a but, but it's actually, but again, the modest slowdown in pay increase on its own is unlikely to drive down inflation rapidly in the near term. They know, like they're putting their employment report, but they're like, yeah, we know, great employment numbers, not good for inflation.
Yeah.
Not good for the Federal Reserve trying to look for, even if they wanted to bring down interest rates to appease the investor classes, as we were talking about, like they at least need the like data points to sort of justify it. And how can they, when they're like, people still keep getting hired, they're making more money. Yeah. We're trying to stop it. And how do we take our foot off the brake when, we're sliding down
Yeah.
or up or whichever direction you want to describe it as.
And some of the discussion of this of these numbers has touched on how wage growth specifically it could really have an impact on inflation, and it could be one of the bigger sectors if it ticks up, because maybe we're going to get over eggs and other things, but that's this wage price spiral is a scary prospect.
Yeah. I mean, it's true. Just looking into some more of the details of this employment report, I mean, there were some losses in small businesses. I mean, only kind of 61,000 total. But the mid-size and large businesses, they added quite a bit. Breaking it down by industry, I mean, it was a gain in every industry except for construction and professional and business services. Now they don't break out, I believe, like tech. I guess information is IT. I guess just like because obviously the tech sector hasn't been doing well, but I mean construction. I mean that was interesting to me. I assume that's in relation to single family home construction slowing down.
Yeah, totally makes sense.
That it definitely makes sense, but again, would typically be a bad sign for the economy. Every other freaking industry sector is up besides professional and business services. Again, that I'm not as concerned about these folks. Maybe I should be. Are we in that category, Matt? Where are we? Yeah. Are we? No, we're financial activities. We gained right? I don't know. Real estate.
All right, good.
We're also we're in a little bit of everything. We're a little bit of construction.
I have a news report here that talks about pay. I don't know. Is there anything about pay on that report? Because what I have
just saying that wages increased, but I don't think they specifically said what the average wage is.
On this little news release I have up, it has that job stayers, their median change in annual pay was 7.2%. Job changers had 14.3% median change in annual pay. Even the stayer, pay growth for job stayers at 7.2% year over year. That's pretty big. It's not right at inflation, but I mean it's pretty dang close.
Yeah.
Even though the pay growth actually this is the slowest annualized pace of gains in 12 months. So I kept hearing headlines that wage growth wasn't keeping pace, and maybe it's still not keeping pace with inflation, but it's not lagging by too much. It's in the running. Maybe not at an even pace, but it's closer than I thought.
And I think there's going to be some inherent lag in that of not everyone asks for raises or gets raises at the same time. And I think once it becomes the norm, I think it'll easily could continue to pick back up. Unless, again, and I think the Fed's seeing that. Another reason why they say they can't take their foot off the brake, because the only thing that's going to really stop that is like people stop hiring new people.
Yeah. And it's this, again, it's like a psychological thing. If they create that environment of expectation of higher wages, then it could really kick off this animal spirit of inflation that you can't control or explain.
Yeah. It's partially the baby boomers' fault, Matt. It's our dads. They all retired. Or your dad's not retired. But he's, and you got an announcement? Or
No, I don't think so. No, not yet.
But it's people are clocking, exiting the workforce, or just, the baby boomers are large group, a lot of them. There's a lot of them. And, they're retiring. And then, so, the Gen Xers, millennials are all getting moved up, and there's just this big gap. There's not that many Gen Xers, and the millennials are moving out of their entry level positions into middle management or whatever. And somebody's got to still work in the mailroom and flip the burgers but no one, those jobs are not inspiring. And I think, we're going to continue to see automation, just flood through the economy, whether that's robots or AI or however you want to parse it. But it's not going to be a choice. It's going to be we don't have anybody to do this.
Yeah.
There's it's not like you can't find enough. There's no one wants to do this. How do we?
Yeah, that is really, we are. It does seem, especially just thinking about that transition from the baby boomers into, really millennials, it's gonna affect the economy. It's gonna affect the housing market, and it already has affected the multifamily market,
Yeah.
although a little differently than maybe some were expecting.
Yeah. Let's keep talking about supply, Matt. CBRE.
Yes.
Looming multifamily oversupply likely will be short-lived.
Yeah.
I tend to agree. They've got some good data here, Matt.
So just to kind of like supplement it, last week we discussed the 400 some apartments expected to be completed in 2023. We were basically looking at some real page data on the roughly 971,000 apartments under construction. And we were arguing that, yeah, it'll probably be closer to 400,000 units completed than it would be, maybe probably not 500,000 completed in 2023, just because there's like a construction backlog, things like labor shortages, materials costs. It just like that log jam itself is probably making each building project that much longer and more expensive, all things considered. So that's why we thought, maybe that our 400 was a lower end. This week, CBRE forecasts that delivery of a near record 716 new multifamily housing units over the next 2 years will push the sector's overall vacancy rate above equilibrium from 4.6 to a peak of 5.2% vacancy by year end. Firstly, 716 over 2 years, that's like 400,000 is bigger than this, 358,000. So this near record number is on our low end. Our lower end estimate, because some people were saying 500,000. 400,000 is still a lot. There's still a lot of supply coming. It could have been bigger, but it's not, it's still near record. My point is that we're going to see a lot of them, but they are being revised down. And there's only so much revising down you could do with a number as big as 971 apartment units under construction. But sooner or later, these projects, like most of the projects, maybe some of the projects, they're going to be completed. I don't think they're going to be spread across every city evenly in the United States. And last week we talked about places like Phoenix, Austin, Dallas, Atlanta. They're going to get more apartment supply than others. And for investors looking to make a multifamily acquisition in 2023, finding a market or really even a submarket that's not going to be flooded with new supply is going to be top of mind much more than it was in the past few years. That is really, and that's something that that was mentioned by Igor Popov in a recent Gray Report video. Something and really great, and you should check it out. I'm going to put the link in the show description. But he mentioned that supply is a real big factor this year. Last year, yeah, it was, and supply is always a factor, but I think it's a bigger factor this year than it has been in the previous 3.
And again, especially since we're, as we've mentioned, some of the headwinds in the market, like right now, the supply on when demand is low. Now, demand, we're seeing signs demand is picking back up, but let's say it stays somewhat suppressed. We could, if you all of a sudden have demand low and supply high, again, like we're talking, pretty basic,
we're already in this sensitive thing, so it's really, really crucial to make that decision and to really get a good view of where apartment supply is going in the markets that you're studying. So the CBRE report, and I found other information in other places for population projections, but basically, this oversupply was based on projections of the population or of factors that didn't hold true to the reality. Sometimes people think that the population places is going to grow, and it doesn't. Sometimes it grows places where you don't think, and it's not an exact science. And my point in all this is that we're going to see a lot of completions, and this it's not that builders are making blind guesses, but if you're building an apartment building, there's a risk that your projections are going to be a little off. And
you're making assumptions based on data that you're taking as fact, but it may not be, or projections. There are other assumptions. Matt, I think that's a really good point. And I've seen these are anecdotes, but I've seen markets where I'm like, I know Bloomington is an example of where, like, if you look at its population growth, it is technically as negative population growth. But the idea that the town of Bloomington has shrunk over the last 5 years is very hard to
Yeah.
square with the reality of being familiar with that market. And then when you look at COVID, we had a census that took place during the pandemic, and
Hmm.
how high quality do we think that was when we didn't even have people going around getting people to sign up and participation rates were low? And the last anecdote is, I mean, I just checked CoStar, Indianapolis's population growth rate on CoStar, and previously it had a projected 1% population growth over the next, basically just under 1% of population growth annually for Indianapolis. Now we're like just below two. I mean,
Yeah.
it's like, or, one, maybe like 1.5 or so, but a relatively substantial move up,
Hmm.
like 6.7 over the next 5 years versus 4.7 or something.
And
Um,
when you're looking at apartment supply, really digging down to the smallest area possible, the smallest relevant area is important because a big city may be shrinking, but that a suburb in that city could be growing incredibly. You can drill in, you can go to the apartment list rent report every month, and you can scroll down and find how the rent growth color for a market is light blue, but then it's really dark bright red for some of the submarkets.
yeah,
So it really matters to look, and that's where supply is going to be relevant too, because a new apartment getting built right across town that may not have a whole big effect on one that's going to be built right
yeah.
in, right next
Well,
door.
I think the bottom line is that you never want to look at, one data point to
Hmm.
make your
Yeah.
decision off of, and from one source. And there's so many different factors that can determine the outcome of an investment. And the employment growth and population growth, like those are very important, but how those affect demand in the future, but how supply and affordability, what the incomes are. I mean,
Hmm.
there's some areas again, I'm using east side of Indianapolis as an example because it's where we're from. That's where I have a lot of familiarity with. East side of Indianapolis, some of the strongest rent growth in the nation right now. Year over year, we're still over 10%, more than Indianapolis as a whole. I think it's like 10.8% according to CoStar right now.
Hmm.
East side of Indianapolis submarket. The reason for that is because there's been basically no supply that's come online in the last 10 or 15 years. No new supply. A lot of decent amount of job growth. The reason why there hasn't been any new supply is the incomes aren't high enough. It's one of the it's the submarket with some of the lowest incomes in Indianapolis. People with low incomes still need a place to live, however. So
Yep.
you've had no supply, people moving in, jobs are actually paying more money, but it's not enough to move the median income. And those median income statistics are delayed and they're lagging. So when developers decide, oh, there are people making enough money to live here, well, they're not getting those signals to start their development process.
Yeah.
So
Yes.
you're talking years out until it actually
Hmm.
happens. You have to have, we've invested in that side of town where a lot of people wouldn't, because for a variety of reasons, we've just been very surgical on that side of town. And not that there haven't been some challenges because it's, lower income areas, but we're trying to buy high quality in those areas and areas where there's a lot of job growth. So we have a higher quality resident coming in. But
Yeah, no,
I'm
that's a perfect example of, this information is not going to be generated and available to builders unless you really have boots on the ground. You can't be everywhere. And there isn't a builder that has their ear to every single market. And so there's going to be opportunities that happen, not because the builders are inaccurate. It's just that information, it takes a little bit of time to be generated, analyzed, and reported on.
exactly, exactly, Matt. Okay, well, so Matt, let's par this data with some of the Realtor.com
Yes.
information that's also coming out. Because again, you can't just look at one source. CBRE, they're trying to sell us on some apartments and some debt, which is all good. I trust what they're saying and giving to us. Realtor.com coming at it from a little bit of a different angle, as you can imagine, more focused on the single family home space, but they're pretty involved in housing at
Yeah.
all. So what's going on with this, Matt?
I think I've included this report, even though, still a little bit of similar supply. supply or anything, but it is a well-deserved reminder that the housing affordability crisis, that crisis that we used to talk about so much last year and year before, because there were not enough homes in the United States, that didn't magically go away. Yes, interest rates have led to falling home values, and it maybe seems like the problem became less of a problem, but increasing interest rates didn't magically create more homes, just messed with the prices for housing property. They're
It did
physically
create some new homes.
what
Did. But just because people were like, I'm gonna build, and the builders were building speculative development only for so long. But sorry, I didn't mean to mess you up.
Oh no, the lower interest rates kind of encouraged development, but raising interest rates, all it did was lower the price of essentially. It created that lower price situation, and it hasn't really. And so there's less headlines about the cost of housing, but my point is that the huge size of the housing affordability crisis is such that it hasn't gone away, and it may be a little bit bigger than the short-term economic issues of just 2023 alone. The big pullout gap with all the good juicy information is here's a quote. It says, the gap between single-family home constructions and household formations grew to 6.5 million homes between 2012 and 2022. However, including multifamily home constructions reduces this gap to actually only 2.3 million homes. But multifamily home construction picked up in 2022 and to reach 35.1% of all housing starts by the end of the year, a level not seen since 2015. Usually multifamily homes were about 31.8, I think, percent of all housing starts, but now it's a few percentage points up. Still not enough starts, and I'm going to scroll down on my notes here.
So basically, we're building a lot. We built a lot the last 2 or 3 years. Mm-hmm. Not enough to dig ourselves out of the hole from the last decade, and now we're slowing down development again. And maybe we got like a third out of the hole. Update.
This is how much we need to dig out. They say that if the total of housing starts increased by 50% from the 2022 rate to get that 22.3 million housing starts per year, then which would involve a pace of construction on par with what we saw in the early 1970s, in some of the peak months for building it in the mid 2000s. Then, if we had that 50% increase, it would take between 2 and 3 years to close that gap. And that's a huge amount. That is more than double we were talking about CBRE, their near record level of, maybe it's 358,000 deliveries a year. The rough number of this is we need, instead of 358,000, we need 731,000 multifamily starts a year. It's a little bit of an apple and oranges comparison because CBRE was measuring completions, but still, that is, we cannot build that many apartments. It's not in the pipeline at the very least. And again, I think the sheer size of this illustrates that it's a bigger issue than I think even the interest rates.
Yeah, and people, I think they're seeing, they're going to downtown Austin or Denver or wherever, and they're seeing cranes still towering the sky, and they're like, there's so many new apartments, we're so oversupplied. But it's like, yeah, we're oversupplied in those several markets for the next year or so, but everywhere else. And again, that's why it's such, the national numbers are important, but if you're making any decision, you have to have a base point, you have to have a reference.
That's very good.
But at the end of the day, it's if you don't know not only your state, county, city, town, township, neighborhood, it's so dependent. It's such a, local immediate proximity game, and you have to have understanding of both, but it stresses the importance of, having those connections and having boots on the ground and knowing what you're investing in and where you're investing, and not making assumptions of, the one that it's easy to fall into. And I've fallen this, especially kind of years ago. If you go to a city you're not familiar with, and you say well, this is this, this is this suburb of my town. This is the Carmel of this city.
Yeah,
maybe it is, but maybe it's not. Is it exactly? And that is a helpful tool.
Exact same thoughts. Yeah.
it's like stereotyping.
Yeah,
Like,
exactly.
yeah, there's usually some truth to that, and it might be
Mhm.
kind of helpful, but you could also make some big mistakes.
Yeah, each
You know,
place is has its own unique pressures and its own unique supply line. But I do think that knowing the national supply numbers impact, at the very least, the idea of renters moving to more affordable markets.
true.
If your rent's above average or something, and that's something that's increasingly happening, especially their reason is largely affordability. So you could be headed to a good place if your average rent in the market you've chosen is underneath the average for the
Yeah,
nation.
yeah. Okay. We've talked about supply, a lot of coming online, not enough. Matt, let's move in. So let's go a little bit bigger picture. Let's you and I, we can talk about investing all day long, multifamily real estate. Let's talk about some really, really ultra high net worth family office folks are thinking. Camden Research put out the ultra high net worth private equity investing report for 2023. And I participated in this survey. And so I got a little bit, I don't know how early access or if they threw it out the same day. Anyway, you're one of the first to know about it if you have not seen it yet. And Matt, before we get into the meat and potatoes,
Yeah.
we're commenting on their use of what we believe is a bunch of AI generated images, such as is my background, a good Dolly 2.0, whatever AI prompt, all kinds of fun multifamily AI renderings. But let's. I just again, this is like not to
I still think
digress, but
I think that the page 89,
these images are, I don't believe, based in reality.
I I think that I think I think they are. That's what I
This
think that they
this is
found
a
some good
stock.
angles.
This is a stock.
Which
This
one?
is a stock image. This 15. This is a stock image.
I hope.
Why would
Yeah,
anyone use
I don't
this?
know. I'm gonna I'm gonna
What is this?
track it down.
What is this? What
Oh,
is that?
it's a sculpture. It's a gateway.
Uh-huh. Yeah. Yeah. Exactly. Anyway, anyway, anyway.
I'm sorry. I'm sorry. I that one. That last one. I'll give that one to you. But I think everything else. I hope it's real. I like to think it's real. And
I think it's a good use of AI.
yeah, yeah.
Now I think these are the first like 15 that they came up with. There could be some better ones. Anyway, let's get into the report, Matt. They've been putting this out for a while, since 1987. Camden has been, they provide unrivaled proprietary intelligence directly from the world's wealthiest families to facilitate peer-to-peer learning. They host like events and things like that. But Matt, what were some of your takeaways? Because there's a lot of
So
there's a lot of data. There's a lot of
it's a long
concepts that there are.
report. Yeah,
It's
there
a
was
lot
like
of report.
100 pages, and it wasn't, so they drill into a lot of meaty issues. And they I don't know how long it took you to complete the survey, but certainly seems like they asked them a lot
It
of
it
questions.
actually took longer than I would have preferred. It actually did
Well,
take a while.
good because they must have gotten they got a lot of value out of it.
Yeah.
They have 10 real main points, and I kind of combined them a little, and I'll run through them
Yeah.
just
Fine.
because
Yeah.
So their main points is so firstly that investment in private equity that's like it's a big commonality for all the survey respondents. 84% are invested in private equity. Another issue that they point out is their two biggest challenges were lack of liquidity and risk of capital loss. You talked about the importance of preservation of principal and the problems that people are running into. Well, yeah, that seems like a lot more people are worrying about that right now. 20% of wealth, they say, is allocated to private equity, which is expected to expand. And then on balance, the average investor is invested in 13 direct deals and 7 fund investments. 9 out of 10 are actually investing in funds, which are primarily bound through family office networks. They also note that investors are looking for reputation and performance when they're evaluating a fund. And then when they're looking for direct deals, they seek out relationships with GPs that have an eye for the quality and they also have an eye for the quality of the management and founding team when they're looking for direct deals. Private equity returns are measured at 24% IRR on average, and only 14% of these ultra high net worth individuals are using online investment platforms for their investments. Although, as they state, they're amenable to the idea, they just don't use it. I would say that's probably generous. If they don't use it, then then I don't know. I don't know.
They're still getting used to it. Yeah, I mean, we've seen a proliferation of these investment management platforms over the last couple of years where it was a nice to have 2 years ago, but not a net requirement. A lot of groups are starting to use them, but not everybody.
Mhm.
Now it's like if you don't have one, you're kind of like, why don't?
Yeah, that I completely agree. I think it's like just the way that we use our investment platform. It's like there are some things that like we can't do unless we do it through the platform. I mean, we
Well,
could do it, but it would make a lot more work, and it
I,
would feel like a lot of going backwards.
I think it's making the institutionalization and professionalization, I would say, of these types of
Yeah.
managing these types of investments a little bit more consistent. I'd
Hmm.
say. I mean, because going back, I mean, you've had groups that have been very professional reporting for decades, but the like the middle market and old school syndication country club model,
Yeah.
especially called pre 2012 or whatever. Um, Even call it pre 2015, I don't know, was, you send them your money, maybe quarterly distributions, maybe quarterly reports, they're not necessarily coming in on time. You're getting you're getting something mailed to you. Maybe you're getting your check mailed to you. And it's sometimes a report, like sometimes there is no report. Sometimes it's just a
Hmm.
check. Sometimes it's a check with a statement of what that check is related to. Sometimes it's a check without a statement, maybe with a quick summary of what's going on, or a combination. And there are still a lot of groups out there that still do that. And some are
Yeah.
really good, and that's okay. And their investors know what to expect, but
That's what I
it's
got the
not the
feeling.
standard anymore.
But I still got and because we've been kind of swimming in this investment platform
Yeah,
uh, waters of that. We switched ours, and we kind of gotten used to what it can and can't do. But I think that I was actually a little bit surprised by the amount of people that still aren't using it, and how like there's a lot of people that are still using the old ways, and they're still making money off
yeah.
of it.
Well, I think, yeah, no, and again, if someone's been around for decades, people will put up with it because their proof is in their returns.
Hmm.
But if you're someone if you're evaluating a new sponsor, a new
Yeah.
fund manager, or whatever, and if you have experienced another sponsor's investment portal, you're like, oh, this is how it should be.
Yeah.
And this is the standard. Like if I'm going to bring in a new sponsor, they better be utilizing technology like this. I want them to
Yeah.
be on this side of the coin
Hmm.
versus, hey, I don't, yeah, you'll get it. It'll be a quarterly distribution. I don't know if it'll be on the quarter or, you'll hear from me, and,
Yeah.
um,
That's what it seemed like.
handwritten note and,
Yeah. Like
couple,
there are things that
wordless.
are less formal than I expected. These are ultra high net worth individuals, they're getting returns, but it's not exactly, there's not set rules that say this is how many reports you have to give, and this is
Yeah, no, I mean, there's some things that are, more common than not, quarterly
Mhm.
stuff that, but now it's like monthly. If you're not, again, quarterly is fine, but like, monthly distributions and, monthly updates are becoming more of the standard, or at least like that's the direction that we've gone to,
Mhm.
partially because, um, people like getting paid monthly. They like getting a distribution every single month. And it's from a sponsor perspective, it's a great way to, how many touches on your investors.
Yeah.
And it's a nice reminder, like, hey, we're out there making things happen. And, on a monthly basis, we're going to get a quick update, not, oh, yeah, well, 3 months ago, we had a problem and we've spent the last 3 months trying to fix it and we haven't. It's like 3 months have gone by.
Mhm.
What's going on?
Yeah.
Matt, just a couple of things I want to highlight, and I want to
Totally.
hear from you on some of the takeaways that you have. And there's, again, we'll probably keep pulling stuff out of this for probably the next couple of weeks, right? This is like a really long
Oh yeah.
piece. Just interesting to take a look at private equity funds IRR dispersion by vintage year. So, what year was the fund launched, and kind of what were those ranges of IRR? So, it's like, what was the market like in that period? Now, I will say, the trend has been for the IRRs to increase over time. They're tracking 2004 through 2017. The reason I don't have any newer vintages is those are still mostly still active. Well, starting, maybe at the widest year of volatility and the widest range, 2004. So these are deals, again, funds launched in 2004. Think, a couple of years after, when some of them may have been exiting or forced to exit, was the great financial crisis. So, they IRRs, some below zero, all the way up to a 40, 40 plus. Those, they kind of declined up through 2008, when then they popped up after 2009. Kind of anywhere from the low single digits all the way up into the mid 20s. And still, decent range, because it's all different types of asset classes, different risk profiles, different, some are good, some are bad. Some people know they're doing, some people don't. But again, it's that IRR has been creeping up every single year of that range, and those expectations of where in the last, several years, no one was losing money. There was no one at zero.
Yeah.
It's all high single digits up to, kind of mid 30s. They said 24%. It's no longer 15, it's 24%. Now we're in a different period, and it's the investor expectations relative to reality. And so that's where it's like, hey, well, the market's only doing, throwing off right now. If we do a deal and it's a low teens IRR, well, the market's really expecting 24. So can you really do a 12 IRR deal? Maybe that's not really what the market is telling you is a good deal right now.
Yeah, there's a couple of different pieces of information here, and I was totally measuring it against interest rates and how much effect those had. It seems like the increase, the steadily increasing IRR that is charted here, it begins, roughly around the Great Financial Crisis, when interest rates were going down. But I
could also draw like a pretty
trend.
trend line going up kind of. Now it'll be interesting in the next couple of years, then the period after this. But it's also more money flowing into private equity also. And so that would also be pushing up prices to a degree. But definitely this is a, higher highs.
It's just hard for me to,
and higher lows.
Yeah. It's hard for me to imagine, if we keep growing at this rate, it went from like 10 average IRR to maybe 20 now. And that's, in what, 13 years that they measured it in this graph. So in 13 years, the IRR has doubled, and it can't keep doing that.
Well, I feel like the pendulum may swing the other way. At least for some,
that's what I'm
the
thinking
next
too.
year or year or so. U.S. private equity dry powder and assets under management. Decent amount of dry powder in 2022. There's about 788, I assume, billion. Could it be trillion, Matt? What does it say? Do you see the?
I bet it's billion, but I'm not.
Yeah, not well. It's not trillion. It's not trillion. It was in like the low trillions, but not 100 trillion. So 788 billion of dry powder just sitting around. And assets under management quite a bit more. Now we are all of a sudden in the $1 trillion range. Yeah, $1 billion, or $2.5 trillion of assets under management. But we've had a little bit of a decrease of dry powder from 21 to 2022. You think a lot that was deployed? Well, I was deployed in 21.
And that answers a question, because I remember we talked about that a lot in 2020 and 2021. About, it keeps building. Is it going to keep growing forever? And it does, it does look like, it was.
So I wonder if some of it was deployed, some of it probably has come off the sideline, or has been put to the sidelines, no longer committed, I guess, if people can do that. So again, we're going to be going through this report over the next.
Yeah, one thing that I did notice, I didn't put it in my notes, was it does have a graph that showed a real big takeoff for venture capital. That was one of these areas of investment that outpaced a lot of other ones in terms like the value increase. And I wondered if that was due to interest rates. But a lot of this report, and this is change tack a little bit, a lot of this work was kind of dealing with a little bit. I think it's marketing towards people that want to sell to these investors. So it's telling them like, here are
That's
your
true. Yeah,
customers.
it's for people who are servicing specifically like family offices and ultra high
Yeah.
net worth. Yeah.
And so they describe it, and they describe the jobs of these respondents. 32% are in C-suite, 26% are founder, 24% family member, 2% portfolio member, 6% other. And then the types of investor, like kind of organizations or the uh, companies or whatever that they invest in. So 43% are single family offices from one independent family business that is independent from the businesses that they run. And then 17% is a single family office that is embedded with the family business. 11% is a virtual family office, which is kind of tech driven with the majority of work outsourced. 11% is this commercial multiple family office that is owned by a third party. And then 7% is private multifamily office, which is owned by families themselves. And then 9% are individual investors. They spend a little bit of time paying attention to this idea of this commercial multifamily office, um, and how for those people that are for each family involved in a multiple family office, they average 256 asset under management, and those offices average 22 families each. For the single family office, which is the biggest category, each family averages 725 million assets under management, and they have a net wealth of $820 million. So these are pretty ultra high net worth. What are they investing for? Long-term returns are by far ranked the highest, but they also really, really, really want to preserve their capital, especially now more than any. And then finally, I just wanted to note the portfolio asset allocation, and it gets at what I kind of said about venture capital, but they have a section of what are these organizations investing in, and it's led by private equities at 26%. It has real assets at 22%. Private equity at public equities are 26. Private equity is 20%. Cash is at 11%. Traditional fixed income at 10%. Private debt 5%. Hedge funds 5%, and then crypto and other are each at 1%. Yeah. So taking just a glance at this, it's pretty well diversified. At least they're holding 11% cash. There's a lot of different kind of assets that these ultra high net worth people are.
So. Well, and I think just compared to your traditional 60-40 portfolio that has come under a lot of criticism recently, especially last year, where not only bonds but stocks both had a horrible year. The 60-40 portfolio not good. And so, what are these very high net worth individuals who have, average net worth, Matt, of what, 800 some million, they're not 60% into the stock market. Now they're looking at, again, as you said, preservation. They're not necessarily trying to grow, but they like to do a little bit of both. They like to grow and preserve. Mm-hmm. Only 26% public equities, that's the stock market. Only 10% traditional fixed income. So, we're only at 36% of what would typically make up of assets that would make up your traditional 60-40 portfolio. Now, 5% is private debt. So, maybe 15% are in bonds on average, again, compared to 40%, which is trying to be, conservative enough. So only 50% that's really in fixed income between private debt and traditional fixed income. Mm-hmm. Real assets. So real estate, infrastructure, mining, stuff like that. 22%. So only 4 percentage points away from what they've got in the stock market. So think about that. What have you have in the stock market? You should have a similar amount or close to in real estate or real assets. Hedge funds only 5%. You already went through this, Matt. Cash at 11% that's a decent amount of cash.
It's interesting, and I think it lines up with a little bit of there's different goals of these ultra high net worth investors, and a lot of them are long term, like characterized by a longer term view than people that really want faster returns now. And I think that
exactly,
when you get to that level, then preservation of capital it becomes so important, and you have a little bit maybe more flexibility to think in these long term ways rather than someone that's trying to really get that multiplier.
Yeah. One other just some metrics. And again, we're going to come back to this, Matt, is what are the challenges associated with people investing in private equity? And again, this isn't just real estate. This is any type of private equity. The biggest reason is not a major surprise, but it's something to think about. And that's illiquidity. Here's a quote from a portfolio manager of a single family office out of the UK. You are giving them, manager sponsor, your money for potentially 12 years. If you think you have made a bad choice, you can't just sell private investments like you can public ones. To make a significant long-term commitment is a real mental hurdle. You're saying goodbye to your hard-earned capital for a long period of time. It's not easy. So there's a lot of other reasons why not to do it. High risk of capital loss. Sure, there's risk in everything. Difficult to evaluate. Valuation levels, limit access to best performing funds. What's at the bottom though is fees. Fees, macroeconomic concerns. It's really the illiquidity is by far and large. The biggest reason would prevent someone from doing more private equity. They like the idea of it, but they're like, I just want to be able to get out.
And that's a structural feature too. That doesn't seem like it's likely to change. It's not
true. Yeah. I mean, there's all kinds of solutions that sort of exist, and it is a problem, and people try to find some solutions, but not necessarily a ton of great solutions, because again, it's relatively opaque. There are marketplaces that sell secondary private positions, but sometimes it's not as easy as just selling it. You have to have approvals to sell it often, and then how do you value that security? It's very difficult.
There's an illiquidity premium. Yeah. And we talked about all the benefits of long-term, but investors want to get in and get out. But I think that I'd like to think that ultra high net worth investors have a little bit larger of a vantage point, and they also have the ability to take on these multiple year investments without needing to take a look at that or use that money in the future. But even being said, the fact that it's such a high, that's high ranking or so definitively means that, nobody wants to part with their money and not be able to use it or touch it for that.
Well, relative to, the public markets where you can get in and out of a position in a couple minutes, if the tide turns, as it always does, I can redirect. I can move in a different direction. I can cut my losses and go to where I need to be and go to, a more efficient place. So when that's an active investor, that's a big concern, and it's a disadvantage of private markets. Now they make up for it in many ways, and there are other people who actually like not having access to capital, having it tied up. I know some people who are like, you know what, I would trade that money. I would do, I might, who knows, I might, I'm not a professional investor. I might make a rash decision. I'd rather have it tied up for a period of time. I'd rather have it, in that asset.
And that's another point too, is I bet that the ultra high net worth individuals are cash rich and time poor, and they probably don't have as much time as less wealthy people that can kind of check every day on their assets.
They can hire a team to check for them.
Yeah, that's true.
That's what the family office do. You got a whole team just for you. Wow. Checking your stuff, checking your accounts, checking your sites, checking your portals.
That's what I was going to say. We got a good team here at Great Cap.
We do, but not to get back to the portal conversation, man. I'm sorry, but one issue that I've seen, especially from like multifamily offices, family offices, and like RIAs and such, is there's too many portals. They got every single, what was the number? 9 funds and a handful of direct deals. Was however many sponsors. Each sponsor's got their own.
That I completely identify with that. That is, and when we set up that portal, that was one of the chief things that I was worried about. Was like the friction that it creates. I got one more password to memorize, one more thing I would love for the concept of standardization to that you can I already have an account on this portal, then I could just go right in and use it. And we had that portal. We had some of the same portal that other groups were using, and it still was a little clunky.
But we kind of want we don't want them to have our information either. So it's like you need to have it closed off, but the investors should have access, obviously. Yeah. But then there's the other piece of where wealth managers, RIAs. They're trying to add many more alternatives to their offerings. They know that they can't just be offering, again, here's our 60/40 portfolio. I can offer,
Mm.
public securities and your traditional fixed income products. It's not sexy. We just saw the chart. That's only
Yeah.
36% of what the real wealthy people are investing in. And people want to feel like they're really wealthy, even if they're just moderately wealthy, high net worth, under $10
Yeah.
million or under $25 million or whatever. They still got a lot of money. They want to invest like the billionaire as well. And you have to offer these more, bespoke offerings. And a lot of that is private real estate offerings or crypto or private credit or other types of alternatives, infrastructure,
Yeah.
whatever it may be. The challenge is they're all on these their own platforms. They're on the they typically have a flag, whether it's Morgan Stanley or it's Stifel
Mm.
or it's whoever it is, and BNY Mellon. They've got their different platforms, and they want their clients. Their client has their portal.
Mm-hmm.
They're like, how do I get your portal to plug into my portal?
Yeah.
They're like, the last thing I want to do is say, okay, client, I'm gonna have to give you another login. You're gonna have to leave our ecosystem.
Yeah. What I wish, and not, you can have your own portal, call it what you want. What if they had just like a generic platform that we hooked up to, that another syndicator hooks up to? We're not seeing any, no one, they can manage what each investor sees or not, but we can all have this one login, and we don't have to learn, 5 different
It's
kinds
just,
of software.
and possibly if it's like view only, but it's like we're
Yeah.
talking about a lot of financial information, a lot of private information. We're talking about social security numbers, EINs, bank account numbers, transferring tens of millions, billions of dollars, through these platforms. And so like what it all connects through and to, and
Yeah.
different more access points can add to the vulnerability to the system. That's not my area of expertise, but I think having some sort of open AI or some sort of, at least if there was like a standard
Like API. Yeah.
API,
Yeah.
so that the different platforms could communicate and get plugged in. And that's what
Yeah.
we've tried to
But
start working on internally.
that's a good point. That almost kind of turned me around. Is the stakes are so high when you're talking about a whole lot of money and some very sensitive documentation.
Yeah, it needs to be treated like the vault.
Yeah.
The
Yeah.
vault. I mean, yeah, we've got extreme. Don't even want to talk about it on the internet anymore. Yeah.
Well, and then like things like making sure everyone's accredited and all these like different little things. Like, yeah, there's some real legal requirements that fall into. So
I can't talk about the vault.
okay, all right,
So
all right.
you heard about the vault?
I probably said too much already.
It's too much been said.
Hey, if you want to be a member of the Great Capital Investment Platform, you only need to go to Great Capital LLC and click Invest with Us, and you will have access.
GreatCapitalLLC.com.
Great Capital. I'm sorry.
Not, or we should get the .biz as well.
Yeah. Well, you could go to you can click Invest with Us, I think, and
No, Matt, they just got to go to GreatCapitalLLC.com.
okay.
Now you are somewhat involved in charge of this, so
I just
but
forgot
I
the
can
name.
I can tell you what it is.
Okay. Thank you.
So you go to the website, Matt,
Mhm.
for credit investors only. If you're already an investor, you can log in right now. Beautiful website. New investors sign up. If you're new to Great Capital, you just need your name, quick information, and then it's great. So you log in, you get your access. Beautiful. Oh, 2-factor. It's too well regarded, Matt. The firewall's up.
Yeah.
The firewall's up.
Security is important.
But I've already got it came to me right away, so I'm not delayed at all. As much as the 2-factor is annoying when you're talking about this, it's important. So you're logged in. You can check out offerings, what's going on. You can get your tax documents. You can get all kinds of different documents, reports, all kinds of stuff. Add stuff to your whatever. It's great. But if you're like, I am not ready to give you my information in time for your portal, well, you won't get to see what the portal looks like. I understand. One thing I highly recommend is still go on to the website, greatcapitalllc.com. I want you to sign up for something different. It's the newsletter. This is the Great Report newsletter is the #1 real estate intelligence newsletter in the world, in the world that Matt and I are specifically aware of. So greatcapitalllc.com. Click the free weekly newsletter on multifamily and economy. You're going to see a picture of me. Just need your name, email. Don't put you don't have to put your phone number, but if you want us to call you, you can put your phone number in there. Like to get in touch. And then you're going to get access to it's the #1 multifamily intelligence newsletter. You said on the planet, Matt? According to Matt Boston.
Yeah. We don't have any assets on Mars yet.
Yeah, exactly. That's gotta wait till 2026.
Yeah.
Big plans. But this is every week, guys. This is not like we've sent this one time. You get all these financing numbers of like, okay, I wanted not only what the 10 years doing is 3.97 today, what's 30-day LIBOR, SOFR, what's the difference? What's the spread between the 10-year and the 2-year? We could have had a whole section on that, Matt. Some examples of recent financing rates, Fannie and Freddie, where are they at? Where's the S&P? What are the REITs doing? What's lumber at? What's Bitcoin at? What's crude oil at? Trying to give me all this macro information, but then all kinds of charts and graphs and all kinds of articles and data revolving in multifamily industry, housing.
Hey, I remember that report.
We were talking about this. So if you want to get this type of granular detail and data sent to your inbox every single Thursday at 8:30 a.m. Eastern Standard Time.
Hey, do you want to read the title of the last article that was listed there?
I saw this article too. Booze-hungry fungus forces Jack Daniels to halt warehouse construction.
I added booze-hungry fungus, but like...
Oh, yeah.
I want to read about the booze-hungry fungus.
The booze-hungry, yeah.
Because this fungus, it's
whiskey fungus, right?
Yeah, it feeds off the ethanol in the air, and it's making some neighborhoods have, the homeowners and other businesses that they don't want the black stain because...
Matt, I come for the rent growth, population growth information, but I stayed for the whiskey fungus report.
That's good. I'm glad I could. That was an unexpected surprise. I had the opportunity to just mention that.
We like to be opportunistic as is appropriate on the Great Report. So guys, hop on over to greatcapitalllc.com. Sign up on the investor portal if you're serious, you're a accredited investor, you want to learn more about us. But then, the newsletter is just, that's a no-brainer. The value proposition there, I think you'll agree, is worth it. I mean, it doesn't cost anything. And again, you want to participate in something that's the best in the world, that's what that is. At least that's what we strive to do. And I think that Matt gotten pretty close and good work. Anything else on the report, Matt?
Not yet. We'll have to wait till news happens. It's going to keep happening.
All right. Well, everyone, I appreciate you watching this entire episode of The Great Report. Make sure you're subscribed. Leave us a comment, good, bad, or the ugly. We'll go over some comments next week, Matt. How about that? So we got some good. We got some people going really into the weeds. Yeah. There was a couple, and I'll drop some responses. Which I'm like, wow, these must be our people. They're getting it, and not that many people saying that we're complete idiots. Oh, our audience is a smart audience. Yeah, no, but I'm saying I know they are smart. They're not. They're not telling us we are wrong yet. Yeah, I'm surprised because I'm not sure if we're right. That's good. Yeah. Well, that's good. Yeah, I'm like, okay, we're not completely off base. Just the quality of comments are really, really high. We appreciate it. Yeah. Thanks to all, Matt. Thanks again. Thank you. Great Report, great newsletter. We'll catch you all next week on the Great Report.